the economy's really going. We get so much crap, so many lies, how great the economy is and how great the tech business is, and when it's not. The problem is we have too many people in Washington and in this industry that just don't tell the truth. The truth is everything. And here at Phil's Gang, we stick with the facts. We tell the truth. We make sure our members, are getting the best information, and our listeners, like you. We make that information available to you and make it simple and understandable.
Good investing means understanding how the stock market works. Join today at philsgang.com.
Whoa!
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grandy.
And welcome to my podcast. Hi, I'm Phil Grandy at philsgang.com. Well, we had this big drop on Friday, over 800 points. And I told my members, do not panic because this is what's going to happen. Here's exactly what I said on that day. Go ahead and play the cut for me, Will. So Trump turned around and threatened them today with massive tariffs. So it'll all get straightened out by Monday, I'm sure, because they both need each other, okay? And that's the way it works. That's the way it works, exactly what I said. So I told them, don't panic, don't jump out. The market would come back, we'll open up Monday morning, we'll be positive, and we did. Matter of fact, if you notice, every time the market does close negative, the next morning, the futures are up positive. So this wasn't going to be any different. And the interesting thing today is that most of the participants were covering their short positions. That's where the participation came. That's why you're seeing most of these stocks, are not back to their, their losses. They're most of them about 25-30% up from their drop. So they captured back maybe, let's say on average, 25% of the drop. So a lot of that is short covering, those who were shorting taking their profits. That was disappointing today. The other thing that was disappointing is the yields are down. That's not good news. Not good news for tech stocks. They like low rates, but for the for the country, the economy, that's not good news with the yields down. So, but we knew this was not going to happen because China and the United States depend on each other. I mean, if we didn't take their goods, what would they do? They've always been trying to build their middle class so they didn't have to sell us goods. It never worked. It never worked. So, they can't play tough guy. And so that's what happened. But the interesting thing is going to be in the next couple of days, because we got the banks, and maybe I'm a little harsh on the returns today being so light, and a lot of stocks can come back to where they were. But there's a big concern about the banks. They're starting to report tomorrow. And we have JP Morgan, Citi, Goldman Sachs, and Wells Fargo. Now remember, the banks, they always put the banks out first because they can manipulate their numbers to always look good. Because they're allowed, let's say a bank says they're going to make $1 million, but they only made $500,000. Well, they don't have to show the $500,000. All they have to do is, let's say they know they're going to have $500,000, not going to hit their $1 million. They just go take another $500,000 from their set aside for losses, shift it over to the profit column, and they made their $1 million. They made their expectations, or they beat their expectation by 1 penny. That's why they always put the banks first, because we always get this rah feeling going. Once the banks report, everything's always wonderful. And, they've always beat the expectations. So that's another thing they're concerned about. But, I really wanted to talk today about how people are really getting screwed in 401ks. What a terrible, terrible thing that was, to design a 401k to put in place of a pension fund. What are you, nuts? A pension fund, it's like a guaranteed retirement, stream of money. You don't have to worry. You get that stream of money coming in every month, whether the market's going down, up, sideways, spinning, buybacks. Nobody cares. You get that same steady stream. Where 401k, you can get clobbered. Look what happened in 2008 and 2009. 401ks got killed, got clobbered. They dropped, I think it was around the 401ks, I think, that, I'm just guessing right now, but I think I can get the number later, but I think it was about 40% is what they lost. But yeah, 40%. And to get that 40% back, they don't go and just get 40% back, oh, we're even again. They have to go with 65%. 65%. The 401k is a failed experiment. It's a horrible thing. First of all, you got fees that are ridiculous. You got all these hidden fees. Remember, when they came out with the 401k, I mean, they really screwed the average guy. I mean, they really did, the worker, the employee. The 401k only really benefited the CEOs and the very wealthy, the top 1%. So when you had a 401k, as I said, right out of the gate, it was a failed experiment because the retirement money, they took it out of the hands of the professional pension fund manager who knew what they were doing. Professional pension fund managers were smart. They got the best, and they managed your portfolio. You were fine. So that the company always made a deal. Look, we're going to give you a wonderful retirement. We're going to give you a pension so you can count on it. It's going to be steady income. Every month you're going to get steady income no matter what the market's doing. And we just need you to build us good products. You build us products, we'll give you a terrific pension, a terrific retirement. But the unions changed all that. The unions got greedy. They wanted more and more and more. And then the unions wanted everybody get rid of the corporation CEOs. They were paying a fortune for pensions. And once they came out with this idea of outsourcing, they said, we can get rid of the pensions now. So when the outsourcing started in the late 60s, 70s, they said, now we got an excuse to get rid of the pensions because they're killing us, right? And that's what they did. And so the pension fund, you took and said, here, let me take this money being managed by an expert, by a professional fund manager, very successful guy, and I'm going to give it to you. You can be another Buffett, Warren Buffett. That's how they sold this. I couldn't believe it back then. They were selling it. Do you want to be another Warren Buffett? You can make your own choices. You can follow the hot stocks, get a hot tip. You're no more locked in. What a wonderful thing. And Wall Street pumped it and pumped it and pumped it. And the CEOs of companies were unbelievable, the money they put behind this thing. And people, really? I could be another Warren Buffett? Yeah, you make your decisions. And you're going to be great at it. Really? Let me ask you a question. I think right now, currently, the decisions that are made for your 401k by these so-called experts, they're costing folks, I think it's something like $41 billion a year. Okay, the terrible advice they're getting. But think about it. They took out of the hands of the experts and they put it in the hands of the worker. What a terrible decision that was. What does the worker know about stocks? They don't have any knowledge of investing in stocks. They have no knowledge. And the proof came, as I said, in 2008, 2009, when they lost 40% because they're not allowed to short. That's the scam with the 401k. You're not allowed to short. Pensions, you didn't have to worry. See, so here they are in a 401k, they lose 40%. If they were in a pension, they would have not lost the 40, they would have kept the gains they already captured. Say they were up 40%. They would have kept those. And then when the market went down, because you're allowed to sell short, the pension fund manager, the expert, he would have shorted. You'd have picked up another 15, 20%. It would have been a win-win-win. But Wall Street doesn't like win-win-wins. They're out to screw the worker, the small middle class. They're out to screw them. And that's exactly what they did with these pensions when they took the pension away. Can you believe that was the narrative? You're going to be another Warren Buffett. They spent millions on an ad campaign like that. So the 401k, because you're not allowed to sell short, Wall Street won't let you sell short because they want to short against you. When you're in a 401k and your stock goes down 20, 30, 40%, a pension manager would be on your side selling short for you. No, not with a 401k. You're not allowed to short. Why? Because everybody on Wall Street, all the hedge funds, the pension funds, all the insurance, they're going to short the hell out of you. And they keep pushing it down, and they're making a fortune, but you're not allowed to sell short. It's a terrible thing. A 401k was setting everybody up to lose from the day they put that thing together. And it's a tax law. Remember, everyone thinks that's the name. Where did they get the name 401k? It was a tax code. It was a tax code so that when the CEOs were getting their pension, and let's say they got a bonus, well, they didn't want to pay tax on that bonus. So there was a code called 401k where they could take that bonus and they didn't have to pay the tax right away, defer the tax on their bonus. They could defer it. If they went to work for a company like GE and somebody said, okay, come work for us, we'll also give you, at the local country club, we'll give you a membership, it's worth $80,000, but don't worry, you can defer that in tax. We'll put it in your 401k. See, 401ks were already in place. The CEOs benefited. The rich were getting richer. And when they turned around and they said, oh, okay, hey, this is going to, they found in the code, Ted Benna found in the code, he just found it by accident, that the code was saying, well, this isn't just for the CEOs and the wealthy. The everyday person can use this. He can defer his income. He can defer the tax on his income. So they went to court, and they finally, the courts agreed that, yeah, it was just by accident that Ted Benna found this. Now, Ted Benna today will tell you that the 401k was the worst thing he ever got involved with. It's a terrible thing. It's all greed. It's awful. So again, when you look today and you say, how on earth could it be that if you have the market, right? Let's think, gold always tells you something's wrong, right? When gold's going crazy. So think about it. Gold is up 35% since April. Spiders are up 36%. 401ks are only up 5% since April. What's that tell you? Expenses are killing you in your 401k. Also, the reason why it's up so little, because they couldn't short. When we had that last sell-off, they weren't allowed to short because they set you up so they can short you. They make the money. You get screwed. So that's the problem with these 401ks. And then the fees are terrible. And you got all these hidden fees. There's 3 major hidden fees they hit you with. And they really screw you with those fees. And so, again, everything, it's all about greed. The fees are nuts. The 3 biggest hidden fees, okay, are the administrative fees, investment fees, and service fees. You got a whole bunch of others, but those are the major ones that really screw you. They went to court on these fees, not to court, but it was a hearing on Wall Street, and they're trying to say, look, you guys have got to stop screwing everybody with these fees. And so, but Wall Street, remember, they pay fees to the organization, I don't remember the name, that oversees them. So there's a Wall Street organization they control because they pay fees every month to this organization, okay? And they pay them so much in fees, and these guys get big salaries and everything else, that guess what? They're not going to go against the big banks. They're not going to go against Jamie Dimon. They're going to go against Wells Fargo. You nuts? So the whole thing, nope, they compromised, but with the compromise, nothing. So we still have these terrible fees that are out there, and Listen, the biggest problem with not selling the short, that's big. That's huge. You can't sell short. That's where they came up with buy and hold, buy and hold, buy and hold, or buy in the dip, cost average down, all that crap. That's all nonsense. You sell short. That's how you make money. You always go with the money, follow the money. So again, right now, the big problem is the labor market. The labor market's going down. The labor market's weak. Wages are weak. And the biggest problem for the 401k is participation. People can't participate. I think it's something like there's a percentage that don't participate. They have a 401k, but they can't participate. They can't contribute. I think it's as high as 42%, something. What is it? 41%. 41%. Why? Because they got to send their kids to college. They're not making enough money. Wages are stagnant. Jobs are terrible. Everybody's going from full-time to part-time to no time. Everybody's working part-time. And so the problem is the reason 42% can't participate. That's a terrible thing. What are they going to have for money when they retire? And by the way, whatever you have for retirement in a 401k, it's just about going to cover your health care. Maybe more when I get back. Join my gang, free for 10 days. Get my stocks.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
Hi, I'm Phil Grandy of philsgang.com. Over the years, I've successfully taught tens of thousands of investors how to navigate the market with confidence. Become a Phil's Gang member and receive the training, the advice, and the software that will take your investing to the next level. I have a team comprised of successful investors, all with proven track records. And the Phil's Gang software is easy to use, painless to navigate, and tells you exactly when to buy, when to sell, when to hold, when to run like hell, even short. Learn about common market mistakes and how to minimize them. You don't have to be a seasoned investor to benefit from Phil's Gang and platform. No matter what level investor you are, my strategies for investing are designed to put you on the path to success. Sign up for the 10-day free trial to see our platform in action. Avoid market pitfalls and start winning with Phil's Gang. Learn more at philsgang.com. That's philsgang.com.
Welcome back. Learn, invest, and make profits with Phil Grandy. Simply go to philsgang.com. Now, here's Phil.
And welcome back to Phil's Gang. Join my gang, philsgang.com, free for 10 days. We've been teaching retail investors how to trade since 1998. That's right. So 401k was a horrible idea, terrible idea. Pensions, that was a great idea because you actually had an equality of retirement period. In other words, if you were in a pension fund, you didn't have to worry about them. You had a steady stream of money. Your 401k, look what happened. Again, can you imagine being in a 401k and the damn thing drops 40% and you got to get 65% to break even and they don't allow you to sell short? A pension fund manager, he'd be ready to sell short. So let's say you're up 30%. Now you're going to go down 30% more and you're going to catch that. You got a short. But see, they don't want you to short because they're shorting against you. And for years, they've been pushing this narrative how shorting is dangerous, terrible, awful, don't short. They did that with 401ks. Do you know that? When 401ks first came out, oh my God, they would stone you to death. They would stone, two things, just like now, they stone you to death now if you suggest there's going to be a crash. But not back then. If you said, yeah, it's a pretty good idea for 401ks. I mean the ETFs. ETFs, good idea. Oh my God, they would kill you. They'd kill you. I mean, unbelievable. They hated them. But now all of a sudden, everything's 401k. 401k is the greatest idea ever. 401k. And spiders, I don't get it. Yeah, I could sit here all day, show you the facts of your 401k, show you the hidden fees, show you the fees against your gains. They deduct 30%. That's without the hidden fees. So if you're up in your 401k, you lose 30% to your fees. What are you, nuts? That's insane. Everybody, oh, but I get a match. Do you know how that came about, the match? They couldn't sell 401ks to save their lives. So finally, I don't know if it was better, but somebody came up with the idea of this 50% match, right? That's what sucks everybody in. But they said, well, we won't tell them. We'll get them on the back end with 30 or 22 hidden fees. They aren't going to gain anything. You don't gain because of that. And let me ask you, think about it. When you look at your 401k tonight, you see it's only up about 5%. That's got to feel horrible. When the spiders are up 36%, people are feeling terrible about the spiders only up 36% because look where gold is. Gold's up over 92%. But again, a 401k is just horrible. Anyways. So pensions were set up so workers could have, as I say, a steady stream of money. And it was a good deal for the corporations because all they do is say, look, we're going to take care of your retirement. A kid could quit high school, go work down at the local factory, and he could end up having a nice life. Nice life. Even though he didn't finish high school, he'd go down and operate a machine in some company. He'd have a nice house. He has kids, family, retire nicely because of a pension. When they took the pension away from our worker, the middle class, it was intended. It was intentional to screw them. It was intentional that would increase the income of the top 1 percentile. That's why they did that. And why? Because stocks would go up because the cost of pensions were high. They would go into 401ks, the cost came way down. But in the end, it didn't. Because what happened was, as time went on, we didn't have the quality of work. People were catching on to these terrible 401ks. They're catching on. Before, when you had the corporation say, I'm going to take care of you. I'm going to take care of your retirement. Well, you build me a damn good product. And people did. It was a great, until they started with this, outsourcing. So this whole thing was all greed. It was get the rich richer. And again, for Wall Street, they loved it because they could scare everybody. Don't short, don't short, don't short. And then they short you. You really get screwed. So, again, it's going to be, nobody's going to move out of a 401k because they suck everybody in with the 50% match. But it doesn't really work because at the end of the day, they screw you with all the hidden fees. Let's see. By the way, imagine when they sold the 401k, they said, you can make your own decisions. What? Yeah, you can be like Warren Buffett. Oh, yeah. Wow, I can be Buffett. Wow. This is what they sold, and people ate it up. I could be just like Buffett. But back then they said, well, we'll give you advisors. We'll give you advisors, okay? You'll have consultants and, what's the other word? Not consultants, but the word's gone. But anyways, so they were always telling the people that were working, they had a 401k, you there's plenty of advisors out there. I forgot the word, but there's plenty of advisors. They'll help you. They'll help you make a decision, right? Well, up to today, the advice that they get, and that's right up to today, the investment advice costs people in 401ks to lose $17 billion a year. Now, if you watch CNBC and Fox Business, you probably double that, okay, those guys, all right? So $17 billion a year, people are losing in 401ks because of terrible advice and the cost. It's always the cost. Remember, trading's about cost, always has been, okay? So, and when they said to the employees when they're trying to get them to switch out of a pension to a 401k that you can trade, you can be another Buffett. I mean, can you imagine? I mean, an employee, you couldn't pick more lousy stock pickers than an employee. What do they know? What do they know? People with this internet has really gotten crazy. I mean, everybody's giving a hot stick stock. Everybody's hot tip. Once they got into the internet, it got really bad. I mean, you go online, there's 5,000 people tell you how to trade, and everybody's got this hot stock, you know? So unless you know how to sell short, you should not be in the stock market. But they mask it by telling you to cost average down. Cost averaging down, if anybody tells you to do that, they should be going to jail. Cost averaging down is the worst thing you could do. You get deeper and deeper and deeper in trouble. Never cost average down. And buy and hold, that's why they sell this buy and hold. So you won't short. Then they convince you to cost average down. That's so dumb. I mean, it's just cost average. No, you add to your position when it's making a new high. It's at 40, now it's at 50, now it's at 51. Make it a new high, I'll add. Oh, it's at 55, now, 56 is a new high. Add again. You add at new highs. Jeez. So again, the real problem is the amount of people that are participating. 46% do not contribute to their 401k. They almost half do not contribute. Why? Why can't they contribute? Because their wages haven't gone up. Their wages haven't gone up. Look at the dollar. The purchasing power in the dollar's killed everybody. Go to the supermarket. Geez, we went over to, what market was it? It was Whole Foods on Sunday, and they opened up a new one, and we went over and looked, and they had a filet. It was unbelievable. I mean, the thing was the size of a $50. It would cost you $33. $33, or something like $45 a pound. And this little tiny filet the size of I don't know, I'd say half a coffee cup sauce, or even smaller than that. And you go look at everything else. Orange juice. I mean, prices are going insane. So that's why people can't contribute. They just can't contribute. So
5 minutes.
So let's go. I want to talk a little bit about stocks. If you go and take a look at what's happening now with these tech stocks, okay, the tech stocks that have driven this whole stock market, okay, and if you look at the AI world, obviously the chip providers, that's where all the money's going, to the chip providers. So let's look at the top chip providers, NVIDIA. Okay, so NVIDIA, I was shocked today that NVIDIA did not, gain back everything. I was shocked it didn't gain back everything. It gained back a little less than half. And this morning, when it opened on its high, it couldn't maintain it. It's not maintaining it going into the opening, to the close. And if you take AMD, okay, that's another one, had a big gap up. If you remember, we had this tremendous gap up from October 3rd to October 6th, and it's just been consolidating. And be very careful with those gaps. Anything that gaps up like that, if I can have another stock there's as good as that one, and there's no gaps, I'll always go to the one that doesn't have a gap. Gaps scare me because when you have a gap, they'll always come back and fill it. Sometimes they don't fill it for 3 months, 6 months, but they will. And when you least expect it, they catch you. But outside of the fact that it has the big gap, it's been very strong. But I would not add to my position in AMD. No way, until it made a new high, an all-time new high, not all-time, but above 240, a 3-month all-time high, I should say. Intel, now that's another one. These are the three. I would not buy these or add to until they make new 3-month highs. New 3-month highs. People are starting to get too excited now, and they're jumping in and starting to buy these again. But again, I thought we'd be, all the losses, I thought they'd grab everything back, but they didn't. Maybe it's because of the banks tomorrow. They're all waiting to see what happens with the banks tomorrow. Now, so if you take the cloud providers, NVIDIA, AMD, Intel, there's no question they're very powerful stocks, okay? We all know that. But those are the first ones that are going to crack. Those are the ones that are going to crack. People keep asking me, when's the market going to crash? When's it going to crash? I'll say the same thing over and over again. It's going to crash. There's no question about it. Because this is far worse than the dot-com days. The dot-com days, you had companies going public you probably had, at least 10 companies a week, more than that, double that, 20 companies all going public, IPOs, every week. We don't have that now. We have the same. You take those three companies, they're the chip providers. Now let's go to the cloud providers, Microsoft, Google, okay? None of them reached their high either. By the way, if you looked at Amazon today, it only got back about a quarter of what it lost on Friday. And then you got the smaller cloud providers like IBM, Alibaba, Oracle, and those are, again, struggling here a little bit today. Especially, I thought IBM would capture back also. So always remember, this whole market, you got three of the biggest chip providers, NVIDIA, AMD, and Intel. You got three of the biggest cloud providers, that's 6. You got 3 more, okay, that's 9. So then you got the semis, like SMH, and you got the other semis. That's it. That's your AI. That's it. And they're pouring billions and trillions of dollars into these, and they're worried. Every time they come up with another story, they would cover it up. Here, listen again. I gave this to you the other day. These stories are so funny. So here's a bad story, right? Listen.
A mild pullback from record highs on Wall Street as further strength in NVIDIA largely offset continued weakness in some consumer and industrial stocks, sharpening the debate about whether AI investment is the main thing carrying the economy right now.
Oh, that's kind of downbeat, right? Oh, the next day.
The S&P 500 gained 0.6% on Wednesday, led higher by the bellwethers of the AI build-out. That would be NVIDIA, Broadcom, and AMD.
So and then again, the next day, it was negative again.
The S&P 500 index fell 0.4% on...
And it goes like that. Every time there's a negative day, they fill it with a positive story. And this is not the dot-com. The dot-com, at least they spread the risk out every day. 10 new IPOs, 10 new IPOs, 10 new IPOs. This is not the deal here. You just one of these stocks has to crack, and they will. At one point, the CEOs are going to stop doing stock buybacks. And when they do, the stock's going to go down a little bit, and then all the tourist investors are going to panic, sell, and the margin calls hit, and that's when the market crashes. See you on the chart. Join my gang. Free 10 days.
You have been listening to Phil's Gang with your host, Phil Grandy, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me to make my dreams.